The depreciation methods, there are three methods to calculate the depreciation. One is called straight line method, unit of production method, and then double declining method or double declining balance method. Okay, so let's talk about that. Number first is straight line method. So in straight line method, it is equal to, the depreciable value divided by number of years of its usage. For example, for just I'm gonna write it years. And how we calculate the depreciated value? Asset cost minus its salvage value. Right? So the benefit of this straight line method is that the depreciation expense would be equal for each year. Basically, you are equal, allowing equal amount of depreciation assigned to each period. And depreciable cost is divided by the useful years to determine the annual depreciation expense. If you want to find out monthly, then you divide further this depreciation expense to 12, or if you want to find out 3 months, then divide by 3 months depreciation. And there are different variation to the question and regarding the depreciation expense. We will learn in our illustration over there. So straight line method formula is cost minus residual value, salvage value or scrap value divided by useful life in a years. So we have question here. We have a cost of truck and its salvage value is 1000. At the end of 5 years it will be sold with $1000 and it will run 100,000 miles. So according to straight line method, what is the formula? Cost minus salvage value divided by number of years, right? The answer would be 8,000. So we're gonna record in our income statement every year record 8,000 as depreciation expense, and the method we're gonna use straight line method. So the entry would be, you see, yearly expense 8,000. The entry would be simple depreciation expense to accumulated depreciation. So every year we're gonna accumulate depreciation and we're gonna write it down on the balance sheet against the truck as because accumulated depreciation is written on the balance sheet and it is a contra account or opposite account of the asset. So that would be the entry. This will go to income statement and this will go to balance sheet, right? So you see here accumulated depreciation is increasing till it is 40,000 at the end of 5 years. So the balance sheet would record it as 41,000 cost, truck, accumulated depreciation 40,000, right? When it hits 40,000, the book value will be 1,000, and then you recover this 1,000 by the sale of this truck. So depreciation method. So as depreciation happen, what happen? Accumulated depreciation start increasing, book value start decreasing, right? And at the end, the asset value become the scrap value, salvage value, or the residual value. So here is the example here. I just want you to pause the video and find out the depreciation expense through straight line method, and at the end match the answer. So I'm just going to show you the answer. Here it is, right? 16. Now the unit of production method. So the unit of production method, basically how much you're going to use the units, and we multiply that units with the depreciation per unit expense, and at the end you find out. So the more you use the plant, so the more they're going to be depreciation, right? So let's talk about this through an example. The same example, that truck is basically will run 100,000 miles, right? The same formula, just a little bit variation is that in the denominator we are using not the time, rather we are using units. So the cost minus residual value divided by useful units, which is 100,000. So the answer would be here 0.40 per mile. So if the truck runs 50,000 miles in 1 year, so its depreciation expense will be higher in year 1. If next year it runs for 20,000 miles, its depreciation will be higher, but not higher as in year 1. So unlike the straight line method, unit of production method results in different depreciation expenses according to the usage of the usage in units of the assets. Okay, so we have the variation, and that is the truck runs 20,000 miles in first year, 30,000 miles in second year, 25,000 in third year, 15,000 in fourth, and 10,000 in fifth year. Simple, we know that 0.40 is per unit. We just multiply it, and at the end you see, at the end the book value become the salvage value, right? What you have to do, you have to multiply each year consumption with the per unit depreciation rate, and then you see it's not equal. In straight line method the expense is all equal, but here the expense is not equal. It is higher, lower, higher, lower, which means it is the yearly expenses is not divided, or we can say that normalized. In accounting term or finance term, we say that it is not normalized, which means in some year it is higher, in some year it is lower. And you see the cumulative depreciation is also, and at the end you fully consume the assets and the remaining value is 1,000, and also 1,000 is our salvage value as well, right? So the unit production depreciate varies with the number of units that asset produces. So here we go. What is the entry then? Entry would not be same in every year, rather it would be different. For next year it's going to be here 12,000, right? Or in others, in 5 year it's going to be, in fifth year it's going to be like here is 4,000, right? Entry is the same, depreciation expense to accumulated depreciation in all kind of depreciation method. So how much is the amount? It depends on the method you use. In straight line method, all the expenses going to be smoothed out yearly basis. In unit of production method sorry, the expense is according to the how much you use that asset. And the last one is